This is the opportunity in small business insurance because it is a profitable segment, and yet you have carriers that might tell you 50% of our stuff, we don't even really 100% know what they do. The net result of that is that customers are being overcharged. If you're not good at segmenting, you're overcharging most of the people by some amount in order to cover the few people that have big claims relatively. And so that's where there's just this massive opportunity that we see. If you can more granularly assess the risk of small businesses, you can actually offer them a lower price, but still a price that it has enough margin in it for us to earn the right underwriting return so that we can operate our business and continue to grow. Hi, this is John Swigart. I'm the co-founder and CEO of Pi Insurance, and this is the future of insurance.
This episode is brought to you by Ascend, the first modern insurance payments platform that will transform how independent agents think about agency bill and premium financing. Ascend eliminates the labor-intensive processes at the point of sale of figuring out how clients want to pay by providing customers an agency-branded checkout experience that automatically offers pay in full or premium financing options for the customer, letting them decide how and when they want to pay. Not only does Ascend simplify the payments and premium finance process, but it helps simplify the payables process by handling all the carrier payables for premium finance policies and soon for all agency billed policies. Ascend takes the best parts of direct bill and agency bill and combines them into a best-in-class experience for both agencies and insureds. Learn more at useascend.com/future of insurance.
John, it's great to finally sit down with you. Before recording, you're like, I can't believe we haven't done this yet, but we're doing it now. Very excited.
Absolutely. My pleasure, Brian.
Can you just give us a little bit of background on you and Pi as well? So, who are you and why are you building what you're building?
Yeah, so my name's John Swigart. I'm the co-founder and CEO of Pi. I started my career in insurance actually a long time ago in college. I'm actually the fourth generation in my family to be in insurance. So I worked at my family's insurance business in college for a little bit, then did some consulting and some corporate finance and found my way to Esurance back in 2000, leading the finance team for 3 years there, and then was chief marketing officer for 10. So I worked all the way until 2013, a couple years after Allstate bought that business in 2011. And left, swore I would never work in personal auto insurance again because that market is incredibly competitive and very, very challenging and with dominant, very powerful players. And then met my co-founder, Dax Craig, in 2016. And we really generated a vision for building a better business for small business owners, a commercial insurance business that put small business owners at the front, served their needs, made insurance more affordable for them, and we aspire to make it as easy as Pi, which is where the name of the business came from.
That was going to be one of my questions. So I'm like, what does it stand for? But there you go, easy as Pi.
Yeah.
So small business, it's a weird thing for me because I came from a carrier that did a lot of small business focus at Hiscox. Everyone talks about how it's this super attractive segment. There's tons of businesses. It's generally is a profitable space to be in. And that's where we want to focus. And yet you look at the solutions that have been on the market or the way that most carriers have been serving it, it hasn't really been fit for purpose. It's off the shelf kind of ISO product that's okay. Maybe not great. Maybe it's good enough. The pricing's okay. The systems are okay. It's like you keep hearing the same story. It's like, but I thought this was this gem. And it does seem like recently there's been a number of newer companies coming online that are trying to serve this space better. But it's kind of shocking to me that if it's such a gem for decades, why hasn't this space been taken care of? Did you have any sense of that?
Yeah, I have a few senses of it. It is a gem. It is actually a very profitable segment for the companies that focus on it and really try to do their best to serve small businesses. The traditional insurance companies, it's quite profitable for them. It's been speculated that when Chubb was trying to buy the Hartford, the primary thing they wanted was the small business sector sort of piece of that Hartford overall company. I think so. My observations are a little bit unique potentially. As I said, I spent 13 years in personal auto insurance and on the digital side of personal auto insurance. So doing it in a new way. What amazed me when I got working on this business with Dax is how, for lack of a better term, pre-internet, commercial insurance is broadly. It's an underwriter-driven business model, and that is true in the small business sector as well, which was shocking to me.
Yeah.
I think that works pretty well in the large size accounts and even the higher end of the mid-size accounts where you really are underwriting a specific business. They have enough activity in their business to do where you have loss history that is specific to that business. They might have safety programs. You might be putting together a large deductible program, evaluating sort of the unique aspects of that business. But at the small end, most businesses don't have losses. There's just not a lot of information in the traditional insurance-y sense of the world, and it's very hard for an underwriter to do work there that's meaningfully differentiating and creating space between this business and this business. And so that's where a data-driven algorithmic approach comes in, which is frankly the way personal lines works. I mean, think about the way personal auto insurance works. There's no underwriter in the personal auto insurance application process. It's data ingested, data feeding an algorithm, and an output of a result. And that is much more like how we go about our approach to assessing risk in the small business sector. I should have said we sell workers' compensation insurance. That's the first line of business that we have. And it's not that we don't have underwriters. We do have underwriters, but they sit behind the algorithm. They're verifying and validating the information that is driving the algorithm. And it's actually important to have that because, and this is actually one of the reasons that that commercial insurance and the small business side hasn't digitized itself as fully yet, is the data ecosystem for commercial insurance is really not very robust. There are lots of companies that are working on it and trying to get it, but the real challenge in whether it's workers' compensation insurance or frankly other lines of business is properly and accurately evaluating what the business actually does. And there's a lot of gray area in that determination, which is not well captured inside the class codes for workers' compensation or the ISO codes for GL or things of that nature. When you think about, again, I'll do a lot of comparisons to personal auto insurance just because that's where I come from. Personal auto insurance is very finite. It's actually quite complex, but it's very finite. You are the number of people on the policy, that there's a gender, there's an age, there's a marital status, there's a driving record associated with that person, there's credit scores associated with them. Those are finite, discrete elements that are very particular. And then you have vehicles with symbols and model years and other things that go with that. And that forms a very discrete sort of structured data set that it has its own sort of realities that you can calculate off of. Joe's handyman service, that's the same thing, does not exist for that. It's what does Joe's handyman service do? What do they do? And the old business categorization information things are just not very good and very robust. And so that's actually one of the challenges that we're working every day to solve, is how do we identify what the business actually does? That's the key to doing commercial insurance well.
Well, and it can change. I mean, we're living in a time where, the pandemic, or you go back to the great financial crisis, where what people did when they started their policy or applied for coverage may not look anything like what they did on the other end of it, because the world got turned upside down and they had to make payroll or, pay their bills. And so, I told the story on the podcast probably too many times, but I had to pay for a house that burnt down where our insured was a painter. I'm like, what kind of paint is he using? Like, he's painting with a blowtorch, but it's because he also had started running cable for electrical work, and he's not, a licensed electrician at all, but he was trying to make ends meet. And he's like, well, I've got things stripped down anyway. Terrible decision. He happened to be painting the house at the same time, so he was in control and custody. But it's like that. None of that was on the app. He may not have been doing it when he applied. But how do you, and there's no website you go to that lists all that out clearly. So
that's exactly right, Brian. And one other thing that frankly was a little bit of an interesting element for me coming into this learning commercial insurance sort of as we built this business, and workers' compensation in particular, you're on the risk when you write the risk. And so many of your listeners who are sort of in currently, John, we know this is, but for other people on the other side, they think, oh my gosh, they're actually a tree trimmer, and they told you they were a accounting firm.
Right.
Well, yeah, if you wrote the business and they turn out to have somebody fall out of a tree, it doesn't matter. You can't
Right.
like say, well, sorry, we're not going to pay the claim because you didn't tell us the truth. In workers' comp, the injured worker is not party to the policy. It's the
Right.
business owner themselves, so you can't withhold. And so you actually do have to verify and validate what they actually do beyond answers to, questions.
Yeah. I've heard a stat that from a few carriers actually that their sense is they're about 50% off, or 50% of their book is miscategorized for, to different degrees, but they've got something wrong about it. So how are you tackling this? Because it's really, it impacts your rate, it impacts your reinsurance, it impacts your losses, all of it.
Yeah. It's frankly one of the most important things that we focus on. And we are creating and constructing and constantly building out what we call a digital fingerprint of the business. So while there's not a lot of structured information out there in the world about sort of what the business does that clearly articulates everything, and even detailed accord forms, on that front, they usually just maybe include class codes or something like that, right? And so there's not great information in the general insurance ecosystem, but where there is information, when the business owner has a website or they have a Facebook page or something like that, they're usually pretty comprehensive and robust about describing the services that they provide. And so that's a great source. And images about the businesses that are out on the website. And so when I say the word digital fingerprint, just imagine hoovering up, ingesting all of the digital exhaust that comes from a business and pulling that in, doing as much automatic assessment that you can of that, but frankly, leveraging human underwriters as well to comb through that and look at that in an efficient way so that you can actually assess that small business risk and deliver a rapid response and an accurate one. It's the key.
Yeah, it is a huge thing. And I think for a lot of carriers, they just default to, we'll have someone look at it, or we'll take a flyer on it, or maybe we'll get it at renewal. Between now and a year later, we'll have a look and then see, but we just wanted the new business and don't stand in the way there.
And so when you think about this, like this is the opportunity in small business insurance because it is a profitable segment. And yet you have carriers that might tell you exactly what you referenced. 50% of our stuff, we don't even really 100% know what they do. So the net result of that is that customers are being overcharged. If you really aren't sure about what specific businesses are doing, but overall you're making money, the only way that works is if you're charging enough into the overall population to compensate for your lack of granularity. And in a P&C insurance environment where the frequency is relatively low and the severity is relatively high, if you're not good at segmenting, you're overcharging most of the people by some amount in order to cover the few people that have big claims relatively. And so that's where there's just this massive opportunity that we see, that basically, if you can more granularly assess the risk of small businesses, you can actually offer them a lower price than the market is offering them, but still a price that it has enough margin in it for us to earn the right underwriting return so that we can operate our business and continue to grow and have, reinsurance relationships that are, profitable for our reinsurance partners.
Yeah. I mean, when you put it like that, it makes a lot of sense. It's like covering the cost of fraud. It's like you can catch all the fraud, or if you want to make sure you're still profitable, it just means you're charging everyone for it. And there's some fat in your system because of the fact that you can't get more exact on whether it's fraud or anything else.
That's right.
That's an interesting point. I am curious though, because so I want to talk about results. We don't get to talk about results with startups often, but here or either, but you happen to have just put out some new results on your growth and your performance. And one of the things that you've talked about is lower frequency than the industry. And you've talked about being more granular and understanding the rate better. Are these things all intertwined?
They are. Yeah, they come from our risk assessment algorithms that are unique to us. We were able to develop them on a wealth of data and have an approach that is very broad in our underwriting. So we underwrite a lot of different classes of business. We were able to algorithmically price and underwrite about 70% of all the classes in the market, in the workers' comp market. And what we're doing, Brian, is I try to explain this in as efficiently as possible. So our algorithms are working and determining and differentiating businesses within a class.
Yeah.
Our algorithms are not doing the work that NCCI and other rating bureaus do. They distinguish plumbers from contractors, from accountants, from roofers.
Yeah.
And they do a great job at that. They get all the data from the industry that, but what they're doing is they're determining an average rate for the average plumber.
Right.
And saying that that's what the rate is. Now, most of the commercial insurance industry that sells workers' comp is then taking that and saying, okay, this is our rate for plumbers, especially at the small business end, right? There's the use of schedule rating is what it's called at the small business end is pretty limited. Some companies have thresholds of premium and so forth that they do. And even if they're using it in kind of these like sledgehammer type approaches where restaurants, if you're a restaurant that have been in business for at least 5 years and you haven't had any claims, you all get 20% credits, right? It just doesn't matter what else is true about you. You're just going to get a 20% credit on. And so what we do is we analytically assess the individual risk of the business relative to similar businesses in its class, in its geography, and other sort of relativities to create a much more granular and differentiated slope up through that schedule rating band. So most states have a plus or minus 25% schedule rating band.
Yeah. So
you can have a 50% variance across, overall off the base rate, plus or minus. And so what we're doing is we're using that whole band. And so fundamentally what the algorithms are doing is they are attempting to pick out businesses that have lower expected claim frequency in the next 12 months. Severity is challenging to predict algorithmically because it's very volatile. Obviously, there are hazard groups and there are other things that sort of likely severities or likely occurrence of high severity events. But we're focused most heavily on sort of capping the severity and just looking at the frequency differences. Yeah. And so that's how we are able to achieve a lower frequency than the industry average because we are picking those customers out. We are providing them with more competitive prices than is typical in the industry. Yeah. Which means we win those accounts and we fill our book of business with positive selection as opposed to adverse selection. And that's a very different way of approaching it than the most traditional sort of insurance space. And when you grow that way, you actually do have an ability to grow very rapidly while maintaining good loss ratios, which is different than the standard way of growing very rapidly in insurance, which is here's everybody else's price level. We're just going to shift down and sell this price level. And so we're selling dollars for 90 cents or dollars for 80 cents. And that's how we grow. Right. And just here's everybody's price level, and we price sort of diagonally across it, and we sell this population.
So you kept bringing up personal auto, so I get to do it now. But it's very, very similar to the Progressive story, where the whole industry was on these really like maybe 4 or 5 steps if they were lucky in their rating, and Progressive was at, I think they had 80,000 price points for.
And now it's probably like 800,000 or 8 million or whatever it is, right? Exactly.
But it was, and people are like, oh, they're cheap. They're not cheap. They might be cheap for you and expensive for the next person. It's that they're the right rate for the outcome they want for that risk. And that's ultimately how you get to, succeeding. And they grew very rapidly and they did that really well. I get that story versus like, we're just going to buy the market and then hopefully we make it up because we have enough of a size book that we can smooth everything out. That doesn't really work out in insurance.
That's exactly right, Brian. They are the best insurance company out there, right? And we have a very similar philosophy and view of the world. and we are a grow as fast as possible, subject to our underwriting results. That's our focus.
It's the second part of it that
Yeah.
needs the sustainability or not. And
Yeah.
so you have grown really rapidly. You what, like doubled the book in the past year or so, isn't that right?
Yeah. So first quarter premium was 100%, a little bit more than 100% over our first quarter of 2021, and that was we've been able to sort of keep that growth rate, and we just sort of hit in the last sort of, when you put the 4 months of the year together and you multiply them by 3, we're sort of right at a $300 million sort of run rate on that, and it's all work comp, right? I like to share. So it just, again, because it's in my brain, in the first 4 years of Esurance, we went from 5 million to 50 million. That was pretty good growth.
And you fought for it.
In the first 4 years of Pi, so 18 through 21, we've gone from 5 million to 176 million. In a much smaller market.
Yes.
And one of the drivers of that, the primary driver is that algorithmic risk assessment and sort of much more granularly segmenting the market than most of the industry.
Yeah.
The other piece is, multi-channel distribution. So we are selling directly. We sell through agents. We sell through both retail agents and wholesale agents, and we sell through partnerships with some pretty key payroll partnerships that we have, and are expanding on all of those fronts. All 3 of those major buckets of distribution grew very rapidly in the first quarter.
Was that multi-pronged distribution story always part of your story, or did you go in with one theory and you adjusted?
Absolutely. Yeah. So obviously at Esurance, we were mostly direct the entire time, although we did work with agents and agencies that had more of a digital flavor. Going into this, I knew we wanted to be direct as part of the business, but we could not scale the business as rapidly as what we needed to do just by being direct. The commercial market is not ready for mass direct. The customers just aren't sort of looking at it. The independent agency channel is very dominant, and frankly, the independent agents serve a big important purpose in especially in commercial lines. While workers' compensation itself is not a complex product, most small businesses have sort of other needs, and they're not insurance experts, and sort of how do you fill this stuff out? The independent agent really provides a lot of value and a lot of help. And so I've never been a believer that customers are sort of monolithic and the whole world's going to go direct or buy it online. Some portion of it will, but lots and lots of other people are not going to. And so we see these channels actually working together. So yes, we were always going to be multi-channel from the beginning. We have people that respond to our television ads, get a quote, talk to one of our sales agents and say, I'd like to talk to my insurance agent about this. And we encourage that. And we say, great, maybe that agent already represents Pi and you can get your Pi policy. Or if not, sometimes we turn it into a customer and an agent acquisition opportunity. So it's the pieces all really do work together. We do get questions a lot about channel conflict and like, don't the agents get upset that you sell directly as well? Some do, and those don't sign up to distribute with Pi if they feel strongly about that, right? But what we find is, since we've always been this way from the beginning, and we're very transparent about it, and we frankly lean towards the agent in any sort of situation where it's sort of questionable, and we let the customer make the choice. So if the customer says, hey, I'd like to still work through my agent, no problem. We'll get that agent on board, we'll pay them a commission and so forth. But if the customer says we want to work with you directly, then we say, well, they want to work with us directly. And so they really do actually work together in our case.
Yeah, it's hard to change if you were agency distributed and at some scale, and that was, that was one of the things that we kept hearing was at Hiscox, we're the only ones who are direct in the lines we're in, which did not include comp. And it was like, any day now, everyone else is going to switch. It's like, well, if they do, we got billions of dollars with these agents who are threatening to shut them off. If they did that, I don't know that that threat is material. But if you're starting from scratch, like we did, like you did, you can be multi distribution channel strategy, and you can survive that way.
It would be very, very challenging for anybody to add on a direct business onto an agency only business today. That would be very challenging.
Understandably, I get that. And I think the agents also understand, well, if they wanted to buy this policy direct, but are still working with me, if I stood in the way of that, that might mean they buy that direct and don't work with me, and they go to someone who's okay with it. So I think we're all sort of coming into that place where we recognize, to your point, that people aren't monolithic, that customers are going to want to work in different ways. And it could be the same customer doing different things in different ways. And we just need to be comfortable with that.
And we don't want to be adversarial and conflict, sort of channel conflict. The word conflict's embedded in that concept, right? So, and we don't view it that way. Like, we want to support our agents, right? We want to make their lives better. We want to make the process easier. We want to help them close more business. We want to help them help their customers better. And so, frankly, it works when we do advertising, when customers show up and they say, hey, I'd like pie, and sort of that name recognition and getting that familiarity. Really just, it helps the agency's business as well.
Yeah, makes it easier for them.
Yeah.
So it all sounds great, but I know that it's not always easy and it's not always great. So what are some of the lessons that you've learned I mean, I know this isn't your first go around in building an insurance company from, from the smallest stages of things, but this is yours, and you've been seeing it firsthand. What are some of the lessons that you've taken?
I would say a lot of reinforcement of lessons, some new, but on the reinforcement side, I would say, Esurance was originally a venture-backed company, and then the dot-com crash happened, and then White Mountains Insurance Group invested in and bought and owned it until it was sold to Allstate. One of White Mountains' operating principles is underwriting comes first. I think that's the right operating principle to have an insurance business, right? You have to build a business around underwriting discipline and balance sheet discipline, and making sure that you understand the risks that you're writing and that you're pricing properly for them. When you build an insurtech business like we have and like so many others have, where we don't plan to balance sheet the majority of the risk that we're writing, so we have to have reinsurance partners. That underwriting comes first mentality is even, I don't want to say it's even more important, because it's always important, but it's paramount in its importance, because reinsurers are great partners, and they have not unlimited patience and willingness to sort of put up with poor underwriting results.
Yeah. And
any insurtech business who loses their reinsurance support,
that can be the end
loses their ability to be in business, basically, right? And so that lesson I already had, and it's just been continuously reinforced. And so we focus on the underwriting results. We pride ourselves on that, and we'll never change that. So we are not a grow at all costs business.
Yeah.
One of the new lessons I would say is, I sort of already knew this, but it's really been brought home. It is all about the people.
Pioneers is what you call them?
Pioneers, absolutely. We call ourselves pioneers. And especially in the market environment that we're in, we have the potential in the commercial insurance market, focusing on small businesses, to build the preeminent business in that sector. The space is available for us to do that. And so it really comes down to the team that we have executing on that vision, as to whether the level of success and the level of sort of the order of magnitude on which we're gonna achieve that. And so I was in finance. I was analytically focused on marketing. I love spending time in spreadsheets. I don't spend very much time in spreadsheets anymore, right? I have to spend all of my time with the team and with building the team, filling the roles, making sure that we have the right people to execute and build on this business. And and it's one of the things that I have grown to really love about the role.
So you said in the beginning that we write workers' compensation for now. I know that doesn't mean you're exiting workers' comp, but
it does not mean we're exiting
the opposite. But do you think your ability and the success that you've had, if you weren't monoline, that it would have been harder to achieve that? Or do you think that, and do you think that that's at risk as you start to think about other lines of business? Or are you building things in such a way that the line of business ultimately doesn't end up mattering to, your ability to execute?
So I do think the lines of business do matter. So we're not going to write every single line of business that's out there. Cyber, for example, is not something that Pi is likely to go into. There's a lot of companies working in the cyberspace, obviously, and
seems like everybody's going into cyber, so there's enough competition.
It's more of a security market, in my view, than an insurance market. There's a lot of expertise that others are applying to that. Interestingly, a shockingly small insurance market, even though it's growing, 80 or 100% a year. But I won't go into that.
No, it like premium wise, it's not where the hype is.
It's microscopic, relatively. And so think of it like our customers are kind of the main street commercial service businesses, right? They are restaurants and retail stores and auto body shops on Main Street. And then they're all the specialty trades, the plumbers, the electricians, the painters, the HVAC, the contractors, they're the transportation businesses, they're the janitors, they're the landscaping businesses. And they have other needs. They have commercial auto insurance needs. They have liability insurance needs. They have some property insurance needs. Those four are the bulk of the commercial insurance market. So where we believe we can have an analytical edge, where we believe we can apply our algorithmic first approach to underwriting that is data driven, we will move into those markets. I do think if we had tried to do that earlier or launched with like 3 products all at once or something like that, it would have been more challenging, because one of the most important things in starting a business is you have to focus. You can have a big vision, and you should have a big vision, but you have to understand that there has to be an order of operations on executing in that vision. And if you try to do too many things at once, you won't do any of them well. Yeah, well said. Thinking more about the future, so what you're adding this year, but beyond that, where do you see things heading for the industry? What's your outlook, whether it's for your business or your market segment or more broadly? Yeah, I think all of those things, our business or market segment and more broadly, I think it is going to be the rapid continued digitization of the market. That does not mean everything's going to go direct. Mm-hmm. So a lot of people equate that, right? Like digital insurance and direct, like that they're like this. What it means is that commercial insurance is finally going to meet the internet in a real way. And it's going to make agents' lives more efficient, better. It's going to make the companies more efficient. It's going to make the customer experience more like what those small business owners are experiencing every other part of their lives. I mean, think about this. Banking has gone completely online for them. Their accounting is now in the cloud, and they're doing it in the different accounting packages. Whether it's if they're Square or PayPal or sort of their merchant services has gone that way. And insurance is still something that they have to get on the phone with an agent and wait days for a response, and sometimes they get told no. It really is one of the areas that just hasn't moved into a similar experience that they're used to otherwise. Again, doesn't mean that they'll all go direct. That's not exactly that's not what I'm saying, but it'll be more immediate. It'll be more real time. It'll be more transparent, and it'll be less costly. There's a lot of premium in the commercial insurance market that is allocated towards covering the expense base of less efficient sort of pre-internet operations. That it's the overwhelming majority of the market. So there is a huge component that is going to that. John, I appreciate this. And
and congratulations on the success that you've had. And it isn't easy. In some senses, it's easy to grow. I know it isn't really, but it's really hard to do that in a true like fundamentals of insurance, sustainable underwriting first kind of way. And I mean, I hear that, and you like drilled into you from the early days at Esurance. I get why it's important to you. I hope it's important to everyone in the industry, but I appreciate what you shared today, and good luck as you continue to expand.
Thank you, Bryan. I appreciate the opportunity. Wonderful spending time with you, and look forward to the next chance.
Thank you to John for sitting down with me for a little bit to share what they're building at Pi, how they're building it, what's different. And it's always great to hear when underwriting outcomes and acumen and the importance of underwriting are at the center of an insurance business. That is why we exist. It is really critical. And it's really interesting. I had a conversation with a venture capitalist in the morning who was looking at backing an MGA. And she was saying, they don't need to worry about the underwriting performance as much because it's not hitting their capital. And I said, well, on the contrary, not that you wouldn't need to think about it if it was hitting your capital, but if you're an MGA and you're reliant on a fronting carrier and a reinsurer, then you really do care, because in a single day, they can turn you off if the underwriting performance is not what it should be. You have less control over that. And so I think John is really right to call that out, whether you're a carrier with lots of reinsurance or an MGA that's totally reinsured. It matters. It matters how your underwriting performance is. And just because you're collecting a fee doesn't mean you can stop caring about the quality of your book. And we can see that in how Pi has built themselves, and just that sense that you have to underwrite, you have to do it effectively, and you can use underwriting to drive the kind of loss profiles and risk profiles that you want if you do it smartly. So very excited to see the progress and the success that Pi has had. We need more of that, right? We need more of these startups coming in, really underwriting successfully, and we need more of the traditionalists who are underwriting well, pushing themselves on the innovation front, the technology front, the customer experience front, just as the startups do. The whole industry, we need both sides of it, the innovation and the underwriting acumen. It's great to see a company like Pi bringing that together. So thank you to John. Thank you to all of you for tuning in. Thank you to Ascend for sponsoring this episode. And I will see you next time. And remember, if you are enjoying what you're hearing, what you're seeing, share the show. You can rate and review on whatever platform you're listening to this on, or if you're on YouTube, subscribe, hit that like button, and of course the bell for notifications. But tell someone that you care about, that that you're interested in seeing their success in the industry. Tell them about the show so they can dig in and get some inspiration about how we can do differently. So with that, I will see you all next time. Thanks, everyone.